Batanai, thanks so much for your time. I mean, it has been a week or so, a full working week that this directive has been in place. Just your thoughts on it and the potential success of this directive in achieving the stated goals.
Thank you. So these measures came on the 7th of May. It was on a Saturday when the president actually announced a raft of measures, or what he is calling capital control measures. So the thinking there is that, there's been a lot of behaviors amongst economic agents in Zimbabwe that were sort of pushing parallel market rates up and also influencing the inflation trend. So part of the measures, of course, was to then suspend lending activity right across financial institutions, your banks, and even the microfinance companies, because the government feels that they have a grip on reserve money, but they don't have a grip on what they call M3 or broad money. So there's a feeling that there's a lot of irregularities within the system that's actually pushing the exchange rate up. But of course, after those measures, we've seen a lot of business leaders are coming out to say that it's not a sustainable move, given that it's hurting growth prospects for a lot of companies, given that they depend on credit by the end of the day.
Any idea of how long it will last, these measures?
So these measures, what we feel from what we read is that there's a lot of firefighting measures, given that the government has taken a stance to really protect and defend a deteriorating ZWL. So they're likely to continue with a number of measures, but it appears that there's a lot of pressure coming out. So what we've seen is the RBZ issuing a number of directives now to say that within certain sectors of the economy, they've actually highlighted marketable commodities such as cotton, wheat, and even tobacco, to say that those sectors are exempt. So we're most likely going to see a number of exemptions coming in to also try and promote productive activity, given that the growth prospects are not looking quite good.
I mean, credit and lending activity is such an integral part of economic activity and growth, as you do highlight. A company that has responded to the implications so far of this directive, Tongaat Hewlett, saying that it can no longer extend advance payments to its cane growers because it afforded to do so by lending from the bank, which it can no longer afford to do, or is no longer allowed to do. And so my question to you is, just speaking broadly on the implications for the economy. If this is what's happening to Tongaat Hewlett, what are the likely implications for other players in other industries and then ultimately growth?
Yes, so the impact definitely, there's going to be a negative impact on GDP growth prospects because productivity is quite key. I think at the moment a number of houses are actually reviewing their GDP growth estimates. We're reviewing them down from 4.5% to 3%. So there's a concern around capacity utilization and the ability for companies to move on. And there's also been an outcry even across different industries, and we're also seeing some listed companies actually withdrawing some of the dividend payouts to investors and the like. So we feel that the impact is going to be on GDP growth prospects, but also on employment levels. As you know, there's need to support households from an employment point of view. So disposable incomes will also be affected. So it's going to be a negative right across the economy.
And I mean, one can even speak of the implications it will possibly have on deposits. I mean, why would I deposit my money in a bank when I won't be able to get it out? But in any case, what are you advising clients to do? I mean, in this environment right now, we don't know exactly how long these directives are going to last. We don't know what more could be done. Is it safe to be putting your money in Zimbabwe right now? Is Zimbabwe investable? And if you've got money there, should you be taking it out in terms of your exposure to the equity market? What are you telling clients?
Okay, so we highlighted to this point when you put out our 2022 economic outlook report to say that 2022 and also 2023 is going to be a year where we are going to see a lot of instability given the election period that we're entering. So it's quite expected when we move towards elections that there are a lot of policy shifts, inconsistencies that also bring about a lot of risk for investors. So in terms of the strategy that we put out at the moment is to say that, you should park your money in the traditional blue chip companies that are well established as a strategy to just preserve value and also try and cushion yourself against the volatilities that are happening as a result of the election season.